we did base currency count, the currency, bid offer, purchasing power parity, average cost, profit calculations.
Thank you.
Okay, so we want to foreign exchange. We did bid and offer, base currency, counter currency, profit loss calculations, average cost. And let's move on to cross rates. Right now, technically, what a cross rate means is if the local currency is not present, it's called a cross rate. Right now, in last week's what we did was a direct quote is where the local currency appears. Well, it's a unit of foreign currency in terms of local currency is called a direct quote, and a unit of local currency in terms of foreign is called indirect quote. Whereas a cross rate is where the local currency does not appear. Right. Normal market practice is to construct a cross rate where the stronger currency becomes the base currency in the cross currency quote. Right. Okay, you don't have to remember the technicals, but now let's do an example straight away. Okay, so let's try these examples. First one is you have a euro dollar. $1.3356 sterling dollar. 1.5675. So the question is, what is euro sterling? Now, if you look at the three pairs of currencies, the first two has dollar as common, whereas the third one does not have dollars. Right? So what you can do is you can insert dollars somewhere in between. It's something like this: 2/5 is equal to 2/3 into 3/5, right? So going by the same concept, let us do this. Will insert dollar in between into US dollar sterling. In other words, this is equal dollar into 1/over GBP US dollar. Right? That's because what we have is dollar sterling and not sterling. We have is sterling dollar and not dollar sterling, right? So we use the inverse, which comes to the same thing, and euro dollar given as 1.3356 into 1/over sterling dollar 1.5675. Okay, so it's basically 1.3356 divided by 1.5675. $0.8521. Okay. Then the second one, $N. UNS 98.90 and $Rupee 133.60. Question is, what is N? So the similar, if you use the similar concept and insert dollar in between, this will be N. Dollar into dollar. N dollar is the inverse of dollar N. What we have is the dollar N and not N dollar, right? So we get the inverse of it into dollar. This is 1 over dollar N 98.90 into Rupees 133.60. Combined 3.09. Then we have finally euro dollar 1.3356 $Rupee 133.60. Question is, what is euro rupee? This is euro dollar. Put dollar in between dollar. Euro dollar 1.3356 $Rupee 133.60. $178.44. Okay. If you look at these three examples that we just did, the first one, euro dollar, is an indirect code. This is indirect. Sterling dollar also indirect, which means they are the same kind. And the outcome, if they are the same kind, you need to divide the two rates, right? You need to divide. Then dollar yen is direct. Dollar rupee also direct. Again, the same kind. So same kind, you again need to divide. Euro dollar, indirect. Dollar rupee, direct. Direct, indirect, you need to multiply. So remember, if same kind, either direct or indirect, you need to divide. And if it's indirect, direct, different kinds, you can multiply. You need to multiply. Okay, so that's the shortcut. Okay, slightly advanced. If you have bid and offer, cross currency bid offer, what do you do? Okay, so let's try these out. Euro dollar, $133.55.60. Sterling dollar, $156.75.80. And so if you look at this, the question is, how much is euro? Sterling. So both are indirect, meaning you have to divide the two rates. So divide which by which? If you look at these exchange rates, you will see that both cases euro is stronger and the sterling is stronger than the dollar, right? So both currencies are stronger than the dollar, but you need less dollars to buy a euro, and here you need more dollars to buy a sterling than euros. So sterling is stronger than euro. Euro is weaker, euro is base currency, therefore exchange rate has to be less than 1. For you to get exchange rate less than 1, you have to divide the euro rate by the sterling rate. Okay, so when you divide indirect quotes, or when you divide, you have to divide across. You have to go across, right? Bid divided by offer and offer divided by bid. That is the direction you have to go. So this will be 1.3355 divided by 1.5680 will be the bid, and the offer will be 1.3360 divided by 1.5675. The idea is bid should be as low as possible, offer should be as high as possible. This is the only combination which gives the lowest possible value and the highest possible value, right? So you have to remember, if it's the same kind, you need to divide across. You will get 85.26. Then we have direct. Again, the same kind. Dollar, Canadian dollar, 98.85, 90, and dollar rupee. Both are direct. Meaning both are the same kind. Question is, what is Canadian rupee? Right. So both are direct, meaning you have to divide. Now, to look at the exchange rates, the first one, US dollar is weaker than the Canadian. Second one, dollar is stronger than rupee. So obviously, the Canadian is stronger than the rupee. Okay. Meaning the exchange rate you get has to be more than 1. So it has to be the rupee rate divided by Canadian rate. And again, you are dividing the same. You are dividing. Therefore, you need to go across. So it will be 133.25 divided by 0.9890, and here it will be 133.30 divided by 0.9885. Then we have euro dollar 133.5560. Dollar rupee 133.2530. Question is, what is euro rupee? So this is direct. Therefore, you need to multiply. So it's different. You need to multiply. When you multiply the same sides, unlike dividing. You don't go across, you multiply the same sides. Right? That is how we get the lowest possible offer. So it will be 1.3355 into 133.5. Offer will be 1.3360 into 133. 796. One 7 8 not 9. Right, so I hope that was clear. Cross currency examples. First question. A German importer would like to buy sterling in terms of euro. At what rate can he buy from the bank following market rates prevail? Right, he's a German importer, he wants to buy sterling. So it's euro dollar given as 132.20.25. He's a German importer who would like to buy sterling in terms of euro. Right. So base currency in this case is euro. $132.20.25. And euro is the base currency. Euro is the base currency. At what rate can he buy from the bank if the foreign markets prevail? So he's an importer, he wants to buy sterling in terms of euro. If he wants to buy sterling, the base currency, he has to sell. Because euro is the base currency. Buying sterling means the base currency is selling. So he says the euro and the bid of 132.20. Second one, a Sri Lankan tea exporter would like to sell euro receivables. At what rate can he sell if foreign market rates prevail? A Sri Lankan tea exporter would like to sell euro receivables. The dollar UNS 132.50.60. Question is, what is euro rupee? 132.20. Why? Because it's indirect direct, so you need to multiply. It is the export, and he's getting euro, so he has to sell the euro. Euro is the base currency. He will sell the base currency at the bid. Right. So bid will be the lower side, 132.20 into 132.50. 175.17. Any questions up to now? Then identifying arbitrage. So arbitrage we have covered already. It is making risk-free profits using mispricing of the same product in two different markets. Yeah. Now, if you look at these rates quoted on the dollar yen, right? HSBC is quoting 98.55.57. Citibank same bid 98.55.58. JP Morgan 98.56.59, and BNP is 98.58.60. Can you all identify arbitrage? Citi is quoting 98.55.58. JP Morgan 98.56.59, and BNP 98.58.60. And so if you find the best possible bid, the best bid, if you are looking to sell dollars, what is the best bid? Meaning, for you, the best bid would be the highest bid, right? It is 98.58. If you are going to sell dollars, you will sell it at the highest bid, which is this 98.58. Then, if you want to buy dollars, you will buy at the lowest possible offer, which is 98.57. Yeah. So, in this case, the bid is higher than the offer, meaning there is definitely arbitrage. So what you can do is you can keep buying at the offer 98.57, and you can sell at 98.58 the bid, and you make money. That's arbitrage. Then the next question: can you all identify any arbitrage in this? So were you all able to identify any arbitrage? There are a few. Yeah. Bank A quoting €1, euro dollar at 134.25.30. B quoting euro dollar at 134.31.36. C is quoting 134.24.29, and D is quoting 134.32.37. So the highest possible bid is 134.32. $134.32, highest possible bid. Lowest possible offer, 134.29. So bid is higher than the offer, which means there is definitely arbitrage. So what you can do is you can buy at 134.29 from Bank C and sell at 134.32 Bank B. There are also other opportunities, like you can buy from C and sell to B. You can buy from A at 30 and sell to B at 31, or to D at 32, right? So, but this is the highest potential. Yes, I hope that was clear. Next question. Selecting the best bank, right? A is quoting dollars at 130, 45, 50. B is quoting dollars at 130, 43, 48. C 130, 44, 49, and D 130, 46, 51. And so if you want to buy dollars, you go to whom? Well, if you're buying dollars, you'll have to buy it at the offer because dollar is the base currency and you're buying the base currency at the offer. So the lowest offer is 130.48, right? So you'll have to buy it dollars at 130.48. You'll be buying dollars ideally from B at 130.48. And if you want to sell dollars, you will sell it. You will want to sell it at the highest possible bid. Highest possible bid is quoted by D, 130.46, right? So you'll buy dollars from B and sell dollars to D. There is no arbitrage because in this case, the highest possible bid is lower than the lowest possible offer. So no arbitrage. I hope clear. Right. So currency forwards, very interesting concept. Now this is based on interest rate parity. Forward rates are based on interest rate parity. What it means is, I will explain. It's a contractual, a forward contract is a contractual commitment to buy or sell a specified amount of foreign exchange for a specified price, which is called the forward exchange rate, at a specified future date or the maturity date of contract. It's used to hedge or speculate in future foreign exchange rate movements. The forward rate is not a guess as to what the spot rate will be on that future date, right? So if you ask for a forecast on the exchange rate, some of us might feel the current rate is 200, it might go to 210, others might feel it might come to 170, right? So we have various views. Now, if you ask for a forecast of 10 different people, they will give you 10 different rates. But that's because that is their expectation. Now, no two people will have the same expectation, right? But if you want, if there is several expectations, then there is lots of uncertainty. Now, if there is uncertainty, it creates a lot of panic amongst investors, right? Some will want to buy dollars, others will want to sell dollars, depending on your view. Those who feel the exchange rate will go up will prefer to buy dollars. But if you feel the exchange rate is going to go down, you will prefer to sell dollars. So what happens, it creates a lot of volatility in the market, lots of uncertainty. Some are buying, some are selling, lots of uncertainty and volatility in the market, right? Now, what you can do is, rather than being exposed to the volatility of the price, you can try and fix the price. That is done through a forward exchange contract, right? So for example, if you book a 1-year forward rate, we'll do an example, then you will understand. Let's say right now, the exchange rate, dollar against rupee, let's assume is at 2.5, right? And let us also say the dollar interest rate is 1% and rupee interest rate 10%. Dollar interest rate 1%, rupee interest rate 10%. So if you have $1 today, right? And let's say you decide to invest this $1 for 1 year at 1%. So after 1 year, this is what happens in 1 year, you will have $1.01 with interest, 1.01, right? So that is option 1. Then what if you had converted this? You had converted this into rupees today, meaning you get 200 rupees, and then you invest the 200 rupees for 1 year 10%, right? So after 1 year, you will end up with a rupee amount of 220. correct? 200 rupees at 10%, you end up with 220. Now, what interest rate parity says is, what this theory says is the forward rate should be based on the two amounts that you get on that particular date. Right? It should be a combination of the amounts that you receive on that particular date. So in this case, it will be the exchange rate. Forward rate will be 220 divided by 1.01. $217.82. How do you get 220? 200 into 1 plus 10%, right? So 220, you get 200 into 1 plus 10%. 1.01 is 1 into 1 plus 1%. If I segregate this, 200 divided by 1, and it's 200 divided by 1 into 1 plus 10% is the interest rate of the counter currency divided by 1 plus the interest rate of the base currency. Okay. So 200 divided by 1 is the current spot rate. Into 1 plus interest rate of counter divided by 1 plus interest rate of the base. This is interest rate parity theory. Like what it says is the forward rate is equal to the spot rate into 1 plus interest rate of counter currency divided by 1 plus interest rate of the base currency. Now, if all of you do the calculation based on these figures, you will get almost identical answers. So you are using the same spot rate, the same interest rate of counter currency, and same interest rate of the base currency. Right? So all of us will get the same forward rate. Forward rate depends on spot rate, interest rate of the two currencies. Yeah, so let's try this calculation. You need to remember the formula. spot rate given as 132.50. 1 month dollar interest rate is 1%. 1 month rupee interest rate is 6.3%. Given the trade date 18 January, spot date 20th January, maturity date 20th February, number of days 31. So you have to calculate the forward rate. Forward rate is spot rate into 1 plus the interest rate of count currency divided by 1 plus interest rate of base currency. Spot rate 132.50. Counter currency is the rupee. Rupee interest rate 6.3% per annum. 1 plus 6.3%. And this is per annum. And you need to calculate for 31 days. Right? It's 31 over 365 because Sri Lankan rupee given as actual 365. The example. Divided by 1 plus base currency interest rate 1%. 31 over 360. This dollar is given as actual 360. You will get 133.09. That is the forward rate. This is the 1 month forward rate. To be precise, this is 1 month forward rate 133.09. Now let us calculate the difference between the forward rate minus the spot rate. It's 133.09 minus spot rate 132.50. So it comes to 59 cents. This is called the swap point. And it's called the swap point. $0.59. And the swap point is the difference between the forward and the spot, 59 cents. Let's try the next example. What is the 6 months forward rate, FX rate for euro dollar given the following market rates? Spot rate 140.45, 6 months dollar interest rate 0.46, 6 months euro rate 1.45. Okay, before we get to the calculation, few more things I wanted to mention. Now, out of these two currencies, right, the rupee has the high interest rate, 6.3 is higher than 1%. So rupee has the high interest rate. And if you look at the exchange rate, spot rate 132.50, forward rate 133.09, right? So that means exchange rate has gone up, and dollar is the base currency. Dollar is the base currency, exchange rate has gone up. That means the dollar has strengthened in the forward. But if you take the interest rates, rupee interest rate is higher than dollar interest rate. Right? Dollar has the low interest rate. So remember, in forward rates, the currency with the low interest rate will strengthen. Currency with the higher interest rate should weaken. You need to remember that concept. So next question. Let's try this. Euro dollar 140.45. 6 month dollar interest rate 0.46. Euro interest rate 145. Right? So euro is in this case has a higher interest rate than the dollar. Now, based on what we learned earlier, if you have a high interest rate, the forward rate should weaken than the spot rate. Okay. The euro dollar 140.45. Then the interest rate of the base currency, which is the euro, is 1.45, and interest rate of counter currency 0.46. Dollar interest rate 0.46. You ask to find 6 months number of days. Let's say 6 months. We'll take it as 183 days. Right. So 6 months forward rate will be the spot rate plus the interest rate of the counter base currency divided by 1 plus interest rate. Counter currency divided by 1 plus interest rate of base currency. So the spot rate 140.45, 1 plus interest rate of counter currencies 0.46, 183 over 360 divided by 1 plus the interest rate of base currency 1.45. I get 1.3975. So shall we calculate the swap point? Which is the forward minus spot. It's 1.3975 minus forward is 1.3975 minus spot is 1.4045. 0.007. It is negative. Swap point is negative. This is what I get, a negative swap point of 7. Okay, and now our conclusion was the base currency interest rate is higher than the counter currency. Therefore, the forward base currency should weaken compared to the count. Right? The count. So, the conclusion was correct because the forward base currency is 139. Forward rate is 139.75. It's down from the spot rate of 140.45. Therefore, the base currency has weakened. Right? So our conclusion was correct. And if you take that scenario, your swap point is negative. You should get a negative swap point. And so remember, if the base currency has the low interest rate, the forward rate swap point is plus, and the base currency has a high interest rate, swap point is negative. Right? So if the base currency is weakening, you say, sorry, if the base currency is strengthening, that means the exchange rate is going up. You say the forward is at a premium. But if the base currency is weakening in the forward, then you say the forward is at a discount. Right? So you can look at the interest rates and then figure out whether the forward is at a premium or at a discount. So if it's at a discount, then the swap point will be negative. If it's at a premium, it will be positive. Forward exchange rates can be higher or lower than the applicable spot rate. The difference between forward is called swap point. Okay, so this is what we discussed just now. Now let's try these examples. Okay, so you have been given the spot rate and the swap points. You asked to calculate the forward rate. Now these forward rates are called outright forward rate. Swiss franc given as 1.0420 30 3-month swap point 30 40. It will help if you write this as an expanded rate. Then it is less confusing. 104 30, right? The swap point is 3040. Now, what it means, what the swap point 3040 means, this actually has to be divided by 1, and you have 4 decimal places, so it's 1, 2, 3, 4, 10,000. Here also 40 divided by 10,000. So this is 0030, and here you get 0.0040. Okay. Now notice the swap point, the bid is lower than offer. That means swap point is plus. These are plus. Then you add. It will be 54, 0, 1.0050, and 1.04. That will be your swap point. Next one. So again, 92.30, 92.40. Three-month swap. $150, $130. Now, if you look at it, the swap point bid is higher than the offer. Right? If the bid is higher than offer, swap point has to be negative. Remember that, right? Bid is lower than the offer, swap point positive. Bid is higher than the offer, swap point negative. This applies only for the swap point. For the outright, I hope that was clear. Let's try the next example. Spot rate given 130, 55, 60. Swap point 200, 215. Huh? So it's actually 200 divided by 1, and there are two decimals. The next one is 215 divided by 100. So this 2 rupees 58 cents. The 6 month outright would be 132.55 and 132.75. Question is, at what rate can you buy 6 months forward? Can you buy $6 months forward? Dollar is the base currency. You'll have to buy the base currency at the offer. Forward offer is 132.75. What rate can sell $6 months forward? Can sell dollars at the bid. Dollar is the base currency, so you can sell dollars at the bid, which is 132.55. Let's try the next set of questions. Euro dollar 133.2530. 6 months swap point 45.50. At what rate can you buy 6 months euros, right? Swap 45.50. 45.50 means you have to divide this by 10,000, and 45.50 is BP is lower, offer is higher, so it's plus. You will end up with 10.00. 6-1 outright comes to 133.70, 138. What trade can I buy 6 months euros? Euro is the base currency. You can buy the base at the offer. So the answer is 133.8. Second one, $yen 98.25.30. So 0.110.105. There's a big desire and offer. Straight away, you should know that swap point is negative. Six-month swap, 110, 105. So 2 decimals means you have to divide by 100. It's 110. 105 divided by 100 is 105. Bid decide and offer, so this is minus. So 6 month outright. And the bank charges a 5 pip margin, right? So the profit is 5 pips from either side, meaning from the bid you have to reduce, offer you have to edit. At what rate can you buy 6 months yen? So if you are buying yen, the counter currency is the dollar. Sorry, the base currency is the dollar. If you are buying yen, you are selling the base. You have to sell the base at the bid. If you are selling the base, it will be at the bid. The answer should be 97.10. You'll be selling the base at the bid, 97.10. Question number 3. $rupee 133.25.30. 6 months swap point 270.75. But can you sell 6 months dollars? $270, $275. Both divided by 100. It's 2 decimals, and it is lower than offer, so it is plus. For the 6 month outright, $133.95, and we have bank charges 5% margin. Again, the margin you have to deduct from the bid and add it to the offer. At what rate can you sell 6 months dollars? Right, dollar is the base currency, so you can sell the base at the bid, which is 135.9. Yeah. So foreign exchange, that is it. Any questions on foreign exchange? Or is it clear? Right. So if there are no questions, let's move on. So budgeting, right? Budgeting is something that we do almost every day without us realizing, right? Because take for example, you travel to office. When you travel to office, you take only a limited amount of money to meet your expenses, your lunch, maybe, or to go out with friends, right? So limited amount of money. You don't take all your wealth and go. Why do you do it? Because you have already budgeted, right? So budget is something which is not new to us. Let's see what the techniques of budgeting. A budget is a document that translates plans into money that will need to be spent to get the planned activities done, and money that will need to be generated to cover the cost of getting the work done. It is an estimate or informed guess about what will be needed in monetary terms to do the work. The process of financial planning is known as budgeting. Budget is an essential management tool. The benefits of budgeting, it sets targets, right? You know what you need to achieve. Budgets are a measure of how much money is needed to carry out activities. So you can allocate resources accordingly. Budgets are a form of communication, right? You can communicate to your staff. You can tell them what is expected of them. Budgets act as the monitoring, coordinating, and control tool. Right? You can exercise lots of control using budgets. It aids the planning process by providing a series of quantitative guidelines which can be followed to achieve organizational objectives. Right? So it can be quantified. The objectives can be quantified using budgets. The budget forces rigorous thinking through the implication of activity planning. There are times when the realities of budgeting process force us to rethink action plans. Used properly, budgets tell when certain amounts of money will be needed to carry out activities, and the budget enables monitoring income and expenditure and identifying any problems. The budget is a basis for financial accountability and transparency. When everyone can see how much should have been spent and received, they can ask informed questions about discrepancies. Right? So it's a very useful tool, but it has certain limitations. Budgeting is a time-consuming and costly job. It's lots of management time spent on budgeting. The development of budget includes many repetitive steps before the final budget is approved. Compared with cost, budgeting provides little valuable, reliable, and relevant information. Budgets are based on assumptions that often turn out to be inaccurate. Budgets also cause a great deal of waste and behavioral problems. People's main goal is to meet the budget, so they always try to negotiate to get lower targets with lower sales and higher costs, which are well known as padding the budget. And so people try to pad the budget. They try to achieve, underachieve, and overspend. Two main budgets, right? Incremental budgets and zero-based budget. So incremental budget are budgets in which the figures are based on those of actual expenditure for the previous year. Right? So what you do is you take last year's expenditure. So the total amount spent is 100. You add a certain amount. You say 10% on top is this year's budget. So this year's amount spent will be 110, something like that. Very simple. with the percentage added for inflationary increase for the next year. This is an easy method that saves time and preparation cost, but it is a lazy way up and is often inaccurate. It prevents conflict between departmental managers since a consistent approach is adopted throughout the organization. But you don't get people, you can resolve conflicts because everyone is allocated almost the same budget, same increase. The impact of changes can be seen and traced quickly. This budgeting technique is only suitable for organizations where each year is very similar to the previous one in terms of activities. It assumes that all current activities and costs are still needed without examining and justifying them in detail. It assumes that you need to continue your status quo. You can't change anything. It's not very flexible in terms of changing, new thinking. Very few dynamic organizations or projects are so stable that this budgeting technique really works for them. There is no incentive to try and reduce cost, and performance targets are often unchallenging. An example. Let's try this example. A bank will have a sizable amount in its budget for staff salaries. In one particular year, staff salaries were estimated at 1.5 billion. When the budget is being prepared for the next year, the CEO thinks that he will need to employ two new senior managers who will be paid a salary of 500,000 each monthly before any pay rises, and also that he will need to give all staff members a pay rise of 10%. Assuming that the new staff will receive the increased pay levels, calculate his budget for staff salaries. Right. The current year, then the budget, one particular year, the staff salaries were 1.5 billion. When the budget is being prepared for next year, the CEO thinks he will need to employ two new senior managers who will pay 500,000 each month. So you add 500,000 each. Let's do it in million. I will say 1,500 million plus 5 million into 1,512 will be this year's budget. This increases by 10%. You add 10% on top. $1,663.2 million. Next year's budget will be, salary budget will be 1,663.2 million. Okay, so I hope that was clear. It's called incremental budget. Then a zero-based budget. Zero-based budget, you need to start every expense at scratch, from scratch. Everything has to begin from scratch. In zero-based budgets, past figures are not used as a starting point. The budgeting process starts from scratch with proposed activities for the year. The result is a more detailed and accurate budget, but it takes more time and energy to prepare budget in this way, right? Because everything you need to justify. This technique is essential for new organizations and projects, but it is also probably the best route to go in a dynamic organization that is proactive in taking on new challenges. Every departmental function is reviewed comprehensively with all expenditure requiring approval rather than just the incremental expenditure requiring approval, right? So everything you need to justify. If you do anything, you have to justify that. Zero-based budgeting tries to achieve an optimal allocation of resources to the parts of the business where they are most needed by forcing managers to justify every activity in their department. So you have to justify everything, otherwise you don't get any allocation. Until they do this, the budget for their department is zero, right? So if you can't justify, you don't get a budgetary allocation. In zero-based budgets, past figures are not used as starting point. Sorry, same thing. The questioning attitude is developed by management, who are constantly forced to ask themselves the questions such as, is the activity really necessary at all? Do you have to do this? Can you do something else, alternative? What happens if you don't do it? Things like that, right? What happens if the activity ceases? Is the current level of provision adequate? What other ways are there of carrying out the activity? How much should the activity cost? Do the benefits to be gained from the activity at least match the cost? All of these questions are largely answered by breaking the budget process down into 3 distinct stages. Activities are identified by managers. Managers are often then forced to consider different ways of performing the activities. These activities are then described in what is called a decision package, which analyzes the cost of the activity, states its purpose, identifies alternative methods of achieving the same purpose, establishes performance measures for the activity, assesses the consequences of not performing the activity. While some form of cost-benefit analysis may be useful at this stage, a degree of quantitative analysis must also be incorporated. Right? So activities are identified initially. Management will then rank all packages in order of decreasing benefits to the organization. This will help management decide what to spend and where to spend it. This ranking of the decision package happens at numerous levels of the organization. Resources are then allocated based on priority. Right? You have to prioritize. Then the benefits of zero-based budgeting. The benefits of zero-based budgeting are substantial. They would have to be, otherwise no organization would ever go for the lens and the lens detailed above in order to implement it. The benefits are set as follows. Right? So these are the benefits of zero-based budgeting. You can eliminate unwanted activities, right? Why not do it? Since zero-based budget does not assume that last year's allocation of resources is necessarily appropriate for the current year, all of the activities of the organizations are re-evaluated annually from a zero base. Most importantly, therefore, inefficient and obsolete activities are removed, and wasteful spending is curbed. This has got to be the biggest benefit of zero-based budgeting compared to incremental budgeting, and was the main reason why it was developed in the first place. Right? So you can eliminate unwanted activities. By its nature, it encourages a bottom-up approach to budgeting in order for zero-based budgets to be used in practice. Bottom-up approach. This should encourage motivation of employees. And you can actually focus on the core areas. What is bringing in the revenue? How can you boost your revenues, bottom lines? Can also be used as a tool to motivate employees. It challenges the status quo and encourages questioning attitude amongst managers. It responds to changes in the business environment from one year to the next. Right? You have to think differently. And you can be a lot more dynamic. You can anticipate changes. You can prepare, gear yourself for changes. Overall, it should result in a more efficient allocation of resources. Drawbacks of zero-based budgeting. Departmental managers may not have the necessary skill to construct decision packages. They will need training for this, and training takes time and money. In large organizations, the number of activities will be so large that the amount of paperwork generated from zero-based budgeting will be unmanageable. Because it will be not an easy exercise. No, every department has to justify themselves, but well, if the department looks very small, insignificant, it can still be adding a lot of value to other departments. Something like maybe janitorial services, right? On its own, it might not look very important, but You never know. There might be non-financial factors, right, in hygiene in the organization, things like that. So ranking the packages can be difficult since many activities cannot be compared on the basis of purely quantitative measures. Right? Gen total services may be the most important thing in the organization, but in your priorities, it might come at the bottom. Qualitative factors need to be incorporated, but this is difficult. Top management level may not have the time or knowledge to rank what could be thousands of packages. Right? So everyone doesn't know everything in detail. They might find it difficult to rank. This problem can be somewhat alleviated by having a hierarchical ranking process whereby each level of managers rank packages of the managers who report to them. The process of identifying decision packages and determining their purpose, cost, and benefit is massively time-consuming and costly. One solution to this problem is to use incremental budgeting every year and then use zero-based budgeting every 3 to 5 years. So you can have a combination of the two. Since decisions are made at budget time, managers may feel unable to react to changes that occur during the year. Right? So budget might be a little rigid, very rigid. You can't have any flexibility. The organization's MIS might be unable to provide the necessary information. So one activity might be important this year, might not be important next year. How do you manage? It could be argued that zero-based budget is far more suitable for public sector than for private sector, right? Because you have to utilize public resources in a prudent manner. And there is another type of budget called a rolling budget or a continuous budget, right? It is what you can do is you can have a 3-month rolling budget, right? So you prepare budgets for every 3 months. Now, after the first month drops out, it goes out, you can drop it out and then add another month. Right? So it's a rolling budget or maybe a 3-year rolling budget. So after the first year goes, you can drop the first year and another year at the end, something like that. It's called a rolling budget. Activity-based budgets. Activity-based budget is based on various activities. Now that might be marketing budget, HR budget, sales budget, expenditure budget. Right? So based on various activities, you can do a budget. That's called activity-based budgets. Comparison of zero-based and activity-based. Zero-based is a method where all expenses have to be justified. Activity-based is a budget where all activities that invite cost in all function areas in an organization are recorded and the relationship between them analyzed. In zero-based budgets, all function in organizations are analyzed for its needs and costs. Zero-based can also be termed as the re-evaluation of program and expenditure of an organization. Activity-based aligns all activities with objectives and helps effective analysis of profit potential of an organization's service and its products. Line item budgeting. Now, this is where you look at maybe a financial statement like the P&L and budget accordingly. Right? So sales, this will be the budget, cost of sales budget, administrative expenses budget, finance expenses budget. Likewise, you can do budgets based on every line item. It's easy to make. Micro level expense control can be done, flexible, and you rely on past data. Then performance-based budgets use statements of mission, goals, and objectives to explain why the money is being spent. They comprises of 3 elements: the result, strategy, and output. It is possible to understand which activities are cost-effective. It's a way of allocating resources for achieving certain objectives. And you can use things like balance scorecard and KPIs. Okay? So what you should remember mainly are incremental budgets and zero-based budgets. Right? Those are the 2 main types of budgets. Remember those. Analyze the features and remember them. Okay, so any questions on budgeting? Okay, so if no questions, let's move on to the next area.
Sir,
Yeah.
hello, sir.
Yeah.
What areas that we should thoroughly study for the examination when we refer this budgeting?
Pardon? Budgeting. On
What are the
budgeting?
key areas?
Yeah.
Yes, sir.
Zero-based and incremental budgets. Those two.
Okay, sir. Thank you.
Yeah. Okay, so the next area is on evaluating portfolio performance, right? So when you construct a portfolio, the next thing is to see how effective it has been. Is it producing the expected result? And if it's producing the expected result, how is it producing the expected result? Is it through a good stock picking or portfolio picking ability? Or is it just the market that is doing well? There's nothing that you could do about it? Or is it something different you're doing, which is very good, right? Something different from the market, which is actually producing good results, right? Performance evaluation improves the effectiveness of a fund's investment policy by acting as a feedback and control mechanism. Right? So performance evaluation is good because it acts as a feedback and control mechanism. It is following. It shows where the policy and allocation is effective and where it is not. It directs management to areas of value added and lost. It quantifies the results of active management and other policy decisions. It indicates where other additional strategies can be successfully applied. And so this is the main reason to evaluate performance, because it acts as a control mechanism, as a feedback mechanism. It gives you indications of where you need to improve and what you are doing right. If you are doing something right, then how are you getting it right? Components of performance evaluation: performance measurement to calculate rates of return based on changes in the account's value over specified time periods. Performance attribution to determine the sources of accounts performance, right? How are you getting it right? Performance appraisal to draw conclusions regarding whether the performance was affected primarily by investment decisions, by the overall market, or by chance. So these are the things that you need to focus on. Portfolio return components. A portfolio return can be broken up into three components: market, style, and active management. Market means the overall market might do well. Style is the individual portfolio manager's style. Right? For example, if the market is just a fixed income market, the selected portfolio manager might be investing heavily in long-term fixed income assets. Right? So that might be his style. Then active management is, rather than following a benchmark, he is on his own doing things differently. Right. So the equation you need to remember is P equals M plus S plus A. Investment manager's portfolio return is equal to the market return. Then S is the return due to style, which is the benchmark return minus the market return. Okay, so S is defined as B minus M, excess return to style. It's the difference between the manager's style index or the benchmark and the market return. S can be positive or negative. Then A is the active management return due to active management. Active return is the difference between the manager's overall portfolio return and benchmark style return, right? So let's try this example. It says the Palist account has a total monthly return of 5.04%. During the same period, the portfolio benchmark return 5.32%, and the market index return 3.92%. You have to calculate the amount of the portfolio return attributable to the manager's active management and style. Okay, so let's work it out. Says the Palest account has total monthly return of 5.04 return, right? P is N plus S plus A. That is a basic equation. Then in this one, the account or portfolio is giving a return of 5.04%. During the same period, the portfolio benchmark return S is equal to the benchmark minus the market. The benchmark is returning 5.32%. And the market index for M is 3.92%. Calculate the amount of portfolio return attributable to the manager's active management, what is A and S. And style. P is equal to MSA. S is the benchmark minus the market. P minus M. Benchmark is 5.32% minus the market 3.92%, which gives you a style return of 1.4%. Due to his style, due to fund management style, is returning 1.4% above the benchmark. Right. Then A. P equals MSA so you can use active return is the portfolio return 5.04 minus benchmark return 5.32. Active return is 0.28%. Right. Now, what it means is the portfolio is giving an overall return of 5.04. So you are breaking it down. How did you get 5.04? Because the benchmark gave 5.32% return. Right. So benchmark is giving 5.32% return. Then the style that you are adopting is giving 1.4% return. Right. So that's pretty good. But your active management, the market has given 3.92% return. The active management has given 1.4% return. But your active management has lost you 0.28%, right? So your actual portfolio is giving you 5.04. That's the analysis that you need to do. How are you getting the portfolio return? Right. Then the benchmark. The benchmark is a standard against which the performance of a security, mutual fund, or an investment manager can be measured. Generally, broad market and market segment stock and bond indices are used for this purpose. Right, so you benchmark, that means you compare your performance against an industry standard. Right, it can be the market. For example, in Sri Lanka, if you're managing an equity portfolio, you can compare yourself against the all-share index return, something like that. That's called a benchmark. Benchmark properties should be are these are the benchmark properties of a benchmark should be specified in advance, right? You have to say what the benchmark should be in advance, right? So if you are managing an equity portfolio, you should say your benchmark is going to be the all-share price index return during the year. And this you have to mention at the beginning, not at the end. It has to be appropriate. The benchmark is consistent with the manager's investment approach and style. So if you are managing an equity portfolio, it has to be reflective of an equity index, equity benchmark. Measurable. Its value and return can be determined on a reasonable frequent basis. It has to be Quantifiable, you have to be able to quantify your benchmark. Unambiguous, you should not have doubts about the benchmark. What is the benchmark exactly? Definitions, everything should be in place. There should not be any ambiguity, no room for any uncertainty. Then it should reflect the manager's current investment opinions. Right? It should have some semblance to the investment ideas, the strategies that he's going to adopt. The manager has current knowledge and expertise of securities within the benchmark. Accountable, the manager should accept the applicability of the benchmark and agree to accept differences in performance between the portfolio and benchmark as caused only by his active management. Right? So obviously, the active management is equal to portfolio minus the benchmark. So he should accept that the difference between portfolio and benchmark is caused by his active management. And he should, if he wishes to be different from the benchmark, he should accept responsibility for that. Otherwise, he can purely follow the benchmark. Investable, it is possible to replicate the benchmark and forego active management. Then how do you construct a benchmark? Identify the important elements of the manager's investment process. Right? Identify the elements. What are the elements that you need to focus on? Select securities that are consistent with that process. What are the securities that are suitable for this? Weigh the securities, including cash, to reflect the manager's process. Review and adjust as needed to replicate the manager's process and results. Rebalance the custom benchmark on a predetermined schedule. Right? You need to rebalance. Review and adjust as needed to replicate the manager's process, and then finally rebalance the custom benchmark as a predetermined schedule. Right. So that's on performance management. I hope it was clear. Okay, so if there are no further questions, we can wind up for today, and I will see you next week. So stay safe. Thank you very much.